We are not teaching the content, we're just sharing the strategies. So today I'm going to go through the financial indicators. So this one, for me, I see that this is in question 3. For me, this is the most important question in the exam. One, because it has got a lot of marks, between 45, anything more than 45 marks come from ratios and financial indicators in question number 3. And also, this question is mostly easy with the least number of calculations. That's the question with almost very few calculations in question 3. So when the learners are writing the exam, I always suggest that they use the 3-4-2-1 method. They start question 1, they answer question 1. They go to question 4, they come to question 3. So question 2, then they finish with question 1. That's what I always advise the learners to do. The 3-4-2-1 method of answering the exam. Because these 2 questions, they don't have calculations. Then question 2, cash flow, can I pencil calculator rubber is for learners. But with this one, with adjustment income statement balance sheet, it's tricky. So let's go to the financial indicators. The first thing that you must know about the financial indicators is that the company now has worked throughout the year. Then they want to see how they performed. Like you are attending class every day, morning, afternoon. At the end, you want to see how you performed. So you have to analyze your own results. So each company is analyzing its own results, number 1, to see how they performed. Number 2, they are analyzing to compare themselves with others. How much they got compared to others. I got 16 accounting. What about my friend? What did he get in accounting? We always compare. So comparison is always everywhere. So companies are making comparison between their performance in different years, or they are comparing themselves with other companies in the same type of business. So you see that in the exam, you might be given one company comparing itself previous year and this year, or one company comparing itself with the next company. Then they can make strategies. Why do we need to compare? So that we see where we did well, we maintain what we did, and also want to see areas where we need to improve. For example, if our expected gross profit was so much and we got this much, or we got less, we need to find areas how to improve, to come up with new strategies of improvement. So how do we analyze? The first thing that we are going to do, we want to see who wants this in financial statements. Remember, we have our financial statements, we have our statement of comprehensive income, we have the statement of financial position. So we want to analyze the result that we find here. If we see the word sales, we see the word sales, 5 million. Our gross profit is 2 million. It's not easy for us to decide whether it's good or not if we just have a number like 2 million. So we need to go further and express that as a percentage to say, okay, compared to ourselves, what was our gross profit? So that's why we need to analyze. So the first thing we have to know, why did we start the company in the first place? Why? JJ? To make profit, isn't it? So our first priority is we want to see whether we made what? Profit. So that is the first thing. So which means we first analyze our profitability. That's the first thing. We have to analyze the profitability. What do we use to analyze those? We are going to go to our formula sheet. We are given 6 indicators there. The first 6 indicators in the formula sheet, they are going to show us whether we made profit or not. So before you answer the question in the exam, you must know what are the indicators of profitability. For example, we have what? Net profit on sales. Net profit on sales. Gross profit on cost of sales. Markup. All these indicators here, we want to see, did we make profit or not? Now, what is it that affects profit? What affects our profit mostly are our expenses. The more expenses we have, the less profit we make. So which means we have to find out a way of controlling our expense. The way we control our expenses is called our efficiency or our operating efficiency. Operating efficiency. That's the first one. So what are the indicators? These indicators affect our profitability here. So what are we going to do? We go to our formula sheet. I always teach with the formula sheet on hand. So if you look at the, oh, thank you very much. If we look at our formula sheet, the first part, you come here. What did I write here? I wrote what? Operating efficiency. So those indicators on the formula sheet with O, they are telling us the operating efficiency. Which ones are they? Operating expenses on sales. They all start with O, isn't it? So operating expenses on sales. On sales. It means operating expense divided by sales. Then we've got operating profit on sales. These ones, they tell us the story of how we are managing our expenses. If we are wasting our water, our electricity, we pay more, and that reduces our profit. So the relationship between these two, if our expenses go up, our profit goes down. So there's always that negative relationship between those two indicators. So who wants to see whether we are making profit or not? The shareholders, again, well, they are the owners of the company. They want to see. That's the first thing. Number two, we want to see, is our business going to continue operating? Do we have money to operate every day? Do we have enough stock, for example? When our customers come to the business, are they going to see the shelves empty or they are going to have goods on them? That is called the liquidity of the business. What is liquidity? Liquidity is how the business manages working capital. So liquidity is about management of working capital. What is working capital? Working capital is about our current assets. Working capital is the difference between current assets and current liabilities. Current assets and current liabilities. Right, which one should be more? Our current assets or current liabilities? Our current assets must be more. But don't forget, when we mention our current assets, we are also including stock. We must not have a lot of stock in our business, because if we have a lot of stock, we are going to tie our working capital. Our working capital tells us all the things that we can quickly change into cash. So we must have as little stock as possible so that we manage our working capital. So what are we going to have? We have the indicators. Like, for example, we have the most important one, the current ratio. Current ratio, AC test ratio, data collection period, There are 6 of them. If you check the formula sheet, there are 6 indicators of liquidity. But when you answer question, you refer to what you are given in the question paper. Okay. Next group. So, as a learner, you must know the groups first of the indicators. For this one, liquidity, what are the indicators? Profitability, what are the indicators? Next one, we are going to be interested after liquidity, very close to this one. We want to see, is our business going to continue into the future? We need to know the solvency. We need to know our solvency. Do we have enough assets to cover our total liabilities? So if we have got enough assets to cover, we are comparing our total assets compared to our what? Total liabilities. That is going to give us what we call the long-term solvency of the business. The more assets we have, the longer we are going to stay into business. If we don't have enough assets, vehicles, we're always hiring vehicles, it means that we're going to end up being bankrupt. So if we don't have, it means that our business must always have more total assets than more total liabilities. Don't forget here, total liabilities we're adding what? Current liabilities and non-current liabilities. Then, if we don't have enough current assets, we are going to end up having a situation of being insolvent. Insolvent or insolvency. It means our total assets are less than our total liabilities. So we have to pack our bags and go home because now we don't have money to operate. Then the shareholders, again, they want to see, now our business is continuing again. Now we want to see, are we gaining from our investment? Remember the shareholders, they bought shares. They want to see, are we gaining or are we losing? So what are they going to look at? They are going to look at what returns are they are getting. Under this, what are they going to check? The first thing, they come back here. They check their net profit. Then after that, now they are going to say, okay, out of the net profit then, what am I going to get for my share? Right? What profit am I going to get on all our shares? Average equity, return on shareholders' equity. All these things, these two, they are the key. Then after this, then there will be others. Because the more earnings you get, the more dividends you are going to get. If you don't have profit, you don't get dividends. Shareholders must know that. If we have got a bigger share, we can bargain for more dividends as well. So the learners must be able to know the groups. Number 5. We are in group number 5. Now, if we sell our shares on the market, what are we going to get? So we need to get our share prices. Share prices. If our shares are sold at the JSE, that's where if our company is a public company, we are going to trade the shares at the JSE. So we want to see how our shares are faring compared to other companies, isn't it? If companies, other people, investors, have got confidence in our company, our share price will go up. So, it means that when we look at our share price, we must compare with something. We are going to compare, number 1, we are going to compare with our own internal systems. We are going to, number 1, we are going to compare our share price with our NAV. Our net asset value per share. Which one should be more here? If our shares, this one is our own price, and this one is the price that outsiders are willing to pay for our shares. So if our shares here, they have a higher value than our own price, then it means that our shares are in demand. But if we put JJ, my little JJ, this phone, if you are selling it for 300, you say, I want 300. That is your name. You are the one who is deciding. Buyers come to you, then they say, this one we can give you 500. Why? They are offering you because they are offering you more because they track this phone, they know it. But this one, yeah, is fast. So it means that your price, market price, your share price, you are going to look at your NAV and the market price. The market price is the one that is most important because it's from the outsider. So your market price must be more than your NAV. Then the other thing you compare, you are also going to compare with the repurchase price. When you buy back the shares, now you are going to compare with your market price. Right. Last one. We are talking about this key. This is what the learners must understand first for them to answer this question. The last one, they must know about the dividend policy. Dividend policy. Right. Dividend policy is about now. Remember, we said here, we were getting return here. Out of this, they are going to pay us a dividend from the earnings that we got. And after paying dividend, then there's going to be what we call a dividend retention. Dividend retention is what they did not pay. For example, let's say our earnings per share, we got 200 cents per share, right? Out of this 200, we pay dividends of 80 cents. How much is left in the company? 120. That 120 is called the dividend retention, and we can express that as a percentage. So sometimes in the exam, they may just bring it, calculate dividend retention. And here we are used to talk about the dividend payout rate. Dividend payout rate. Right. So for you to solve this one, so let's say the question is saying calculate dividend that is retained. What are you going to do? First of all, you are going to calculate the dividend payout rate. How much amount was paid as a dividend, then you subtract from the earning that we got. And that the difference is going to be, for example, let's say your dividend payout rate is 80%. Again, it means that the dividend retention rate will now be 100 minus 8, which is 20%. So it's easy, step by step. You first calculate the dividend payout rate, then you subtract from 100. That gives you your dividend retention. Right. So the first thing before you think of indicators, you must know these main headings. Because the questions are going to ask you about command. Then the last group, number 7. Number 7 is risk and gearing. And this one, what is risk? Financial risk. If you take a loan from the bank, there is a risk that you may not be able to pay back the loan. And if you don't pay back the loan, are they going to say, thank you very much? No, they'll come after you again. They start selling your assets, they take you to court. So that's a risk. Which means, if we say, if you take more risk, you take more loans from the bank, what's going to happen to your risk? It's going to increase again. If you take more loans from the bank, you are going to have what? Yes, your risk will increase. So here we talk about gearing. Risk also always goes with gearing. What is gearing? Gearing means how much loan you have. The more loans you have, the more gearing you have. Good gearing, good you are supported. Ne? You have your own money, your ordinary share capital retained income, right? But at the same time, you are supported on the other side by the loan. That's why it's called gearing. It means if you don't have the loan, you will fall because your equity is not enough. So if you take more loan, you are increasing your gearing. And once you increase your gearing, you are also increasing your what? Your risk. Which means now, if you take a loan, you must not take a loan to go and buy pizza. You must take a loan so that you can generate more money from the loan. If you generate more money from the loan, it means, for example, you borrow a loan at 20% per annum, right? It means now you are going to use this money, this loan, then what you get, the bank is expecting you to pay them this one. Then you use this money, you do whatever you do with it, then you get 25% on the return that you are going to get on the loan. Return on total capital employed. Then it means now that you see you are going to pay 20. Let's remove the percentage. You took 20 rand from the bank. You borrowed 20 rand from the bank. You used it. You got 25 rand. How much did you gain? You gained 5 rand. So which means the loan is assisting you, is helping you. You are making profit from the loan. So we say your company is positively geared because you are gaining something from the loan. You are using the loan effectively. The loan is working for you. Now, what must you do? You can go to the bank, take another loan because you are using it in a profitable way. That is positively geared. So, which means when you are looking at positive geared, you compare your return on total capital employed with your interest on loan. They always go together. Interest on loan, rotate, they go together like this. So always, as a rule, your rotate must be more than the interest on loan. Then the company is positively geared. Don't forget that keyword, please. When you write your answers, always include this keyword. The company is positively geared at the end. That's the conclusion. Right. Then suppose now you borrow 20, you are going to pay 20%, but you use the loan. You only get 16%. If you are talking in rands, you borrow 20 rand, you only got 16 rand. Now you must go and pay back the 20 rand again. So what is going to happen? You take all the 16 rand again, go and pay it, and take another 4 rand from your pocket. So which means the loan is making you to lose money. And we say the company is negatively geared. So when you're answering question in question 3, make sure that you are familiar with these keywords and you mention those things. The company the ROTE is more than the interest on loan with figures. Conclusion, the company is positively geared. The company is negatively geared. That's how you get more marks. Any question, my good learners? All right, so let's go to the question. After the theory, let's go to the question 3, page 51. We are going to see now how do we use our keywords now. We know liquidity, solvency, risk, gearing. We want to see how we are going to use that. Let's look at question number 3.1. In our formula sheet. Okay. 3.1, let's read. I always like my learners to read with me. Quote and explain to which is managing its expenses more effectively. And we said if the company is managing what we see, yes, we are going to see with how they are going to get their profit from the operating expense again. So we are going to check our information that we are given. Let's check information A. Always, because this question has got answers. It's more like a comprehension. You read, you go and look for the answers. So all the answers for this one, you get them from information A. Let's get to information A. So they are saying, quote and explain financial indicators to show which company. Underline the keyword there is which company. We are given two companies there. Right, so what do we look at now? The first thing, we must know which indicator to look for. We are looking at what? Operating expenses on sales. And what else we have? Operating profit on sales. Like I said here, they all start with O. Right. Now, before we look at this one, my good learners, let's cover this side. Operating expenses on sales. Do you want it to be a high number or a smaller number? Operating expenses on sales. Do you expect a bigger number here or a smaller number? Smaller number, isn't it? Then operating profit on sales. Smaller number, bigger number? Bigger number, right? So let's go and check. The company with smaller number, bigger number. Which one is it? 11. What do we say? Operating expenses on sales. So we are going to write, when we are commenting on these indicators, we are going to use this method. When you are commenting, I advise you to use this method. We are going to use ITF method. But sometimes we are going to use ITFE. You mention the indicator, then you mention the trend. Trend is about increasing or decreasing. Then you mention the figures. But as I will show you, sometimes you also have to do explanation. ITF, then you put an E in bracket. Indicator, trend, figures. So let's take an example. We said from our formula sheet, our indicator number 1, 3.1, operating expenses on sales. Right. Now, which means for this question, they said, explain, if I may go back, it says, quote and explain two financial indicators. They did not say which company is managing. Can you see that? So, which means for us, we must be careful with the questions. So, for this one, we are going to quote indicators for the one that is what? Managing properly. Right. So we are not going to mention the name of the company. We are just going to mention the indicators for that company. If you mention the indicators for the other company, you get 1 mark for only the indicator. So we said we are going to quote for Ilembe again. So we are going to say operating expense. You are just copying and pasting here. You are not calculating. Operating expenses on sales. Then we check on Ilembe. Yes. Operating expense on sales. Let's check what happened. We are now going to, here there are 2 ways we can do it. We can compare it with last year. Let's start with that one. Operating expense on sales decreased. That's the trend. Can you see that? The indicator, the trend decreased from, now we are going to mention the figures, from 18.2% to 14.9%. Please, my goodness, let's avoid calculating the difference. Let's avoid saying 18.2 minus 14.9. That gives us what? 3.3, 3.1. Please let's avoid writing operating expense on sales decreased by 3.1. Let's not do that. Because once we do that, then it means that they've got to mention points, percentage points, which becomes complicated. So, yes. Okay, I'm saying here it decreased from 18.2. There are other learners from other schools who are used to calculating the difference between this amount and this one. Then they will say decrease. So they don't say decrease from, they say decreased by 3.1% like this. Sometimes they mark it wrong. Because they will say you must now talk about percentage point basis, like they do on the market, on the JSE, whatever. So that becomes a challenge to learners, especially level 1 and 2 learners. Then others, what they can do, they will say 3.1, that's the decrease, isn't it? 3.1 divided by 18.2 times 100. That gives us what? You see that now it's creating a lot of complications now. So let's avoid. Let's avoid that. Yes. So let's avoid this thing of saying by this amount. Let's just say from this to this. All right. You know how the markets are working on the GAC. Okay, they are talking about the movement of shares. They are talking about the movement of indicators. So when they talk about the movement of indicators, they talk about the movement in terms of percentage points, not the movement of absolute figures. They are talking about the movement of percentage points. For example, the shares of PEP have increased by 25 basis points. Sometimes you see the SARB, they increase. If you look at the SARB, they will say we are going to increase by 7.5 percentage basis points. So when you are talking about this movement, you are talking about the movement by the percentage basis point. I'm not sure that I'm making it clear or I'm making it worse. Or maybe someone can. Yes. Mhm. Yes. Yes. Mm. Mm. Exactly. Okay, it's fine. All right, it's fine. Okay, no, it's fine. No, thank you. Just simplify it. Okay. All right, it's fine. Yeah, because a lot of learners from what we've seen is that once they forget to put the percentage points at that word point at the end, they always forget it and they lose marks for that. So to be on the safe side, let's just avoid it altogether. Right, let's go to question 3.21. 3.2.1. Oh, sorry. Oh, yes. Oh, it is two. Oh, yes. The other one, operating. Do you see we are just copying and pasting here? Operating profit on sales. What happened? Then you tell the story. What is the story of the opening? Let's see. Increased from, now we are writing the figures, from 22% to 24%. Normally, when we mark this, if we see the indicator here, it's 1 mark. The trend and figures, normally it's 1 mark. Unless the system of marking is changing, like I heard, maybe. But for this one, it's a straightforward question. Just there's no complication on that one. So the learners must get. Let's go to 3.2, earnings and returns. Where are we? Earnings. You remember my heading? Earnings. So once you see the word earnings, something must come to your mind. What do you think about? The first number one. The number one indicator of earnings and returns. Earnings, earnings per share. Returns, ROCE. So when we go to make the comment, we have to get that in mind. 3.2.1, comment on the percentage return on shareholder equity of each company. You see, now they need 2 points. So which means now we are simply going to go there. We check, we read return on average shareholders equity. Do you see the difference in this question? They said comment on the percentage return on shareholders equity. But here they are saying return on average shareholders equity. That they've added the word average. Follow? They added to the word average. So you must know that it's the same word. So we check. Let's go there. We start with Umzinyat, right? What happened? You write indicator, return on shareholders equity. What happened? Decreased from 13.4% to 9.4%. That's 1 point. Next point, you do the same for the other one. Now, right. Colleagues, this one now I'm no longer explaining to learners now. I'm explaining to us as educators. Colleagues, this one, I think I'm not explaining not to learners now. They said comment on the, we said Rocher, right? For Msingwan again. What happened with the first company? You decreased. I suggest we do this to our learners now because I think the new markers are coming up with different ideas. So decreased from 13 what? 13.4% to 9.4%. In the past, we used to mark like this. We used to mark like Rocher, 1 mark. Decrease from this to this. You understand? But now they are saying now, this whole thing here is 1 mark now. That's what I heard from those who went for June mark. So they are now saying, unlike last year, this whole thing like this is now 1 mark. And you can see that this question is 4 marks. So we must now say, we must come here. Yes, we must provide explanation. Let's encourage the learner to provide explanation. After writing indicator, trend, and figure, they must provide explanation. What is our explanation here? It means what? That the company has decreased its profitability. Let me help you. Yes, the company's profitability.
It has decreased.
Yes.
Correct. Now you are explaining what the markers are saying now. The new markers are saying, if we say Rochelle has decreased from this, everyone can see it. Okay. Everyone can see it. It has decreased from this place. So you must go further and say, what does this decrease means?
We are talking about the returns.
Yes.
Yes. Then it's not what it affects the profitability.
Yes, Mr. Manuel.
I see the other one. If the learner is saying your share is 15% is higher than the interest alternative investment. Yeah, it's higher than the 10.
Yes.
Compared to down here.
Yes.
Yes, I don't know what the learner will get that 2 marks or not.
I was going to come on that one. So, which means here, because you can see this question is open-ended again.
Yeah.
They said comment on the percentage of each. So the learner has got 2 options.
Yes.
Write like this with indicators and explain what it means. Or the learner can compare that Rochelle with interest on fixed deposit or with interest